Everyone thinks they can time the Bitcoin market, but what if I told you that most fail? Meanwhile, smart investors are quietly stacking Bitcoin stress-free. So which strategy actually wins? Timing the market or dollar cost averaging? In this video, we're going to break down the real results, showing you who comes out on top and why this could change the way you invest Bitcoin forever. So stay tuned. So let's meet our two investors. Investor A believes they can time the market, only buying Bitcoin when they think the price is low. Meanwhile, Investor B takes a different approach, using dollar cost averaging or DCA by investing a fixed amount regularly, no matter the price. So let's jump into a scenario where both start with $12,200 and they invest it over a 5-year period. So who will come out ahead? Let's dive in. Okay, so if you refer to this interesting resource called the bitcoin.dollarcostaverage.com, you'll be able to see a simple way to find out using the historical data in terms of previous Bitcoin prices, taking account of its volatility, so its peaks and troughs over a certain period of time. And you can see if we follow through this scenario that I've just mentioned just a moment ago, let's say the investor A, which is like the time market adventurer who wants to actually buy a handful of Bitcoin based on that $12,200, which you would put here as a parameter. And let's say the person actually made a one-off purchase because he thinks he can time the market better than anyone else. So he made the purchase, let's say, on February 9th last year, 2024, with a one-off payment amount of $12,200. And if you click on purchase here, you can see the person 1 year later has actually averaged a rate of return of 113.8%. And based on the Bitcoin price at February 9th, 2025, a year later, he's managed to amass 0.269, so almost 0.27 of a Bitcoin at that $26,000 price, using his original investment of $12,200. So this is the adventurer person who thinks he can actually time the market better than anyone else, including professional traders or not, the case may be. Now, let's look at the same results based on the investor B, which is a more prudent dollar cost average investor. So what I did here is I've specified a $200 monthly installment amount, so a dollar cost average amount purchase of Bitcoin every month for the next 5 years. So what I did was I've kind of backtracked this scenario starting on February 9th, 5 years ago, so 2020. Like I said, $200 every month for the next 5 years would equate to the same amount as with the investor A, $12,200. And you can see that the dollar cost average scenario has actually favored much greater rate of return than the initial investor A. You can see he's over doubled the 113 rate return on investor A, and in this case he's made just under 300%, which would translate itself into a greater amount. He's more than doubled if you compare with investor A. Is made 0.27, and here is almost double, so it's 0.49 of a Bitcoin at that price of $47,400, using the same original investment amount as a whole to $12,200, even though this dollar cost average investor has made monthly installment payments of $200 every month during the 5-year period. So you can see the result is unanimous. If you refer to this website, you can actually pluck some additional parameters and also some different set of dates. And you can see overall, there may be one or two instances of a fluke where the one-time adventurer could actually favor a better return than the more prudent dollar cost average investor. But you would see quite rapidly, playing around through these figures in this website, which is very interesting, you come to a rapid conclusion that the dollar cost average investor will overwhelmingly win, hands down, than the more adventurous one-time investor. So this is really the upshot of this result. So after 5 years, the results are very clear. Investor A struggled to time the market. They missed the best buying opportunities, hesitated during dips, and consequently has ended up holding cash instead of Bitcoin. Meanwhile, investor B stuck to the DCA strategy by buying Bitcoin at both highs and lows, but ultimately getting a better average entry price. Now, studies have shown that even professional traders fail to time the market correctly. DCA removes emotions and lets Bitcoin's long-term growth work in your favor. So in the end, investor B ends up with more Bitcoin and higher gains than investor A. So hopefully you found this episode inspiring and convincing enough that in effect DCA is the most effective strategy. And it just stopped there. What I would do in my case as a Bitcoin holder, I use DCA, but more importantly, you need to actually hold it for the long term. So you might have heard the acronym HODL, HODL, which is a terminology used to mean that it's a long-term holding asset. It's not something you want to fall into the trap of relinquishing some of these fancy gains in any moment of time. No, you need to actually be brave and courageous enough to say, well, I'm going to be making these DCA regular payments over a period of time, a long period of time. And in addition to that, I'm going to be hodling for the long term. In my case, it's going to be a minimum period of 10 years because I'm very, very confident that I'm going to be seeing significant rate of returns at the end of the 10-year holding period. So hopefully you found today's episode inspiring. And if you enjoyed it, please hit the like button of this video and share it with your friends and colleagues at work. And if you haven't done so already, please subscribe to my channel as I regularly post some interesting videos, anything to do with Bitcoin, blockchain technology, and the future finance. So I'll see you next time.